Hello, everyone. My name is Elias Carson, and I'm a graduate student at Georgetown University majoring in business analytics. We welcome you to a student's intro to alternative investments, where we have the opportunity to learn from current leaders in the alternative investment industry. Today, we are diving into the topic of new products with John Grady. John, can we start by sharing a brief overview of your career path and how you first got involved into the alternative investment industry?
Nice to meet you, and thank you for the chance to talk. So my career path started with my decision to go to law school after college. I had a strong interest in getting the legal training, but no real sense of how I wanted to apply it when I left school. That said, I had always been interested at the same time in markets. So as a law student, I took a lot of classes in corporations, in finance, in things that were at least pertinent to or maybe diving deeply into the nature of our markets, our securities laws, our laws that pertain to the investment of capital, the trading of securities and the like. So I focused on that in law school. And when I came out, I really wanted to go to a law firm, get the training that came with being a young lawyer there, with all the folks who could teach me and mentor me. But I really was looking out for assignments that involved securities law and involved regulatory policy at the same time. Interestingly, that's asset management in a nutshell, because the asset management space is not just a disclosure space. It's a space that, thanks to laws adopted by Congress back in the 30s and early 1940, there are substantive rules on how money is managed. There are substantive rules on how investors' assets are pooled and managed collectively in things called mutual funds or in closed-end funds. And the more I found that area, and the more work I did in that area, the more I was convinced that I had found the path I wanted to be on. From that point, then now more than 40 years later, I have had a number of experiences that involve asset management, sometimes running companies that ran funds, sometimes serving as a lawyer to companies that built funds and ran funds. So from those different experiences, I found myself really gravitating toward alternative assets. Alternatives being assets that don't correlate to stocks and bonds, but assets instead that have diversifying effects when they're included in your portfolio. And that's been where I've really spent probably the last 15 years, starting with commodity pools and futures trading back in 2009, and continuing today with my role at ADISA.
Thank you for that response. With such a long career in the industry, what were some of the most significant changes that you've seen in the past decade or so as it relates to the alternative investment industry?
So I think that the alternative investment industry has really undergone quite a change in the last decade or so, partly due to trying to come out of the great financial crisis, understanding how investments that we were making, investments that we were offering to investors could work in a world in which the markets could take half your wealth away from you in a single year. And we could use the concepts of diversification and non-correlation to work for investors, but also in ways that allowed them to build wealth and allowed them to retain that wealth through lower volatility as a portfolio matter. So I think the industry has really come into its own. It's not a single asset industry. It includes ways of doing business that include multiple fund types, multiple asset types, and folks who coming into the industry are really impressed with how much diversification, not just of the product type, but also the asset types that we put into our pools and sell interest into investors. So I think our industry, like our association, has broadened and grown as a way of making this diversification benefit more broadly available than ever.
And just to follow up on that question, what do you believe were the catalysts to the changes that we've seen in the past few decades?
I think that you can't understand what's going on in the securities space without understanding that our regulators, particularly the SEC, are trying to achieve two somewhat contradictory goals simultaneously. On the one hand, they're trying to foster the development of markets, and they're trying to ensure the raising and growth of capital. On the other hand, they're trying to protect investors. So the pendulum swings back and forth between policies designed to really foster investor protection and policies that sometimes foster growth of capital. I think our industry has understood the need to provide those protections that the regulators really wanted to see introduced into products, into everything from how they're priced to how they're marketed to how they're talked about on the one hand, so that we help them meet their investor protection goals. And at the same time, we were developing strategies and funds that were responsive to investors' desire to be exposed to new assets and new strategies, in ensuring essentially that there was capital for the projects that folks wanted to fund and that would lead to economic growth. I give the industry a lot of credit for, look, those are two waves they were riding at the same time, not always in the same direction, and sometimes one would seem to be more difficult to respond to. Particularly investor protection can be very difficult to respond to because too much investor protection tends to shut down capital raising. So our goal has been to try and seek balance, to try and encourage the regulators to understand the value of balance. And as an industry, I think we've done a pretty good job of living that balance.
What skills do you think were essential for you to be successful in your professional journey, especially as it relates to regulation compliance and new product development?
So I think that particularly my early training as a lawyer, where there was really an emphasis on, if you were going to say it, you said it correctly. If you were going to write it or think it through, you had to argue correctly. You had to organize your thoughts correctly. You had to draw on the right evidence for your position, depending on what it was. It really was a way to sort of eliminate lazy thinking, a lazy approach to things from your whole approach. And as a result, you become skilled at both advocacy, but also understanding the value of working hard to be as accurate and as thorough as you can. Those are skills that serve you well as a lawyer. They serve you well in a law firm. They serve you well in almost all aspects of being a lawyer. But I mention them because the world of alternative investments and the securities law generally is a very information-intensive part of the world. This is not a space where the documents are few and far between. In fact, they're at the center of what we do. How funds describe themselves, how asset managers describe what they do, how they disclose the risks, how they disclose expenses, how they tell the regulators what they're trying to do and how the regulators respond. All of those are set forth in things that are created. They're written, now electronically transmitted, but they're documents. And I think the legal training helped me appreciate the value of good work going into documents, and not just seeing documents as something to get to the final page so you can turn it and move on, but rather recognizing that you had to build something that could stand the test of time. One of the most valuable lessons I learned as a young lawyer was when I got involved in litigation over some fairly ordinary commercial transactions. In one case, a guarantee. In another case, a pension obligation of a company. And in each case, what you discover in litigation is you go over the documents that the parties entered into with a fine-tooth comb, and you're looking for weaknesses. You're looking for mistakes. You're looking for essentially a way of reading the document that will enhance your client's position. And nothing did more to teach me the importance of getting it right the first time and not saying, well, that's good enough. Because it might be good enough in maybe even in your client's mind, good enough to get to a signed document. But if that's going through the mill of an adversary review process a year or two later where folks are arguing over what the language means and you didn't work hard to make it clear or concise or both or consistent, then there's going to be issues. And so I think that was a formative experience for me, was to really understand in a world in which documents are voluminous and they are everywhere, it's still important to get them all right.
Thank you for that. Can you discuss a specific challenge you faced early in your career, particularly as it relates to alternative investments, and how you overcame that challenge?
So I think one formative experience I had was when I was working with a matter that was being litigated where a company executive had been very, very optimistic about his company's chances, about a new product they were working on, and the likely success of that product. And those were remarks that were made in company meetings, they were made to journalists, they were made in conversations with analysts. And then when the company didn't perform quite as well as those statements, the stock price collapsed and the executive and the company were sued for misleading the markets with these statements. And to me, it was very much a formative experience in understanding how the power of what you tell people is ultimately going to be the context in which you are arguing for the success or lack of success of your product. You can have a successful product, but if you promise the moon and only deliver half the moon, you're going to actually be more accountable for what you didn't deliver than what you did. So from my standpoint, learning in that formative experience that in our marketplace, we place this country, our system places an enormous value on sort of candor and on a lack of exaggeration, because the exaggerations are the things that people will come back and say, you know what, you weren't honest with me, you weren't candid with me about what I should expect or what you were doing and how well you were doing it, and therefore you're liable for those statements. And learning that and helping teach executives, so I translated that into a set of, I became somebody who worked with companies to develop ways that their executives could talk to analysts and talk to money managers and talk to the press, and not exaggerate. And it sounds simple, right? You should be able to have rule number 1, don't exaggerate, end of rules. But it's not that simple, because they say, well, can I say what I think? Can I say what I hope? Can I say what my financial officer told me to expect? Can I say what some vendor I'm dealing with told me to expect? Can I say what our biggest customer is telling me? And the answer is often, well, maybe. It depends on how much you can prove versus how much you're just sort of engaged in wishful thinking. So from my standpoint, learning, again, that there's a value to a process where what you have to say is guided not just by sort of some abstract, don't exaggerate, don't mislead, but rather processes that help you disclose without exaggeration and talk about things that you should talk about and stay away from things that you shouldn't talk about. That to me was very formative.
Thank you. Since you touched on communication, it made me consider how important soft skills are becoming and have been in not only alternative investments, but most industries. And I just wanted to ask, were there any specific soft skills that you feel can help a young entrant like myself stand out, or that you feel that I should emphasize more to be successful in the industry?
I think if there's a soft skill that really helps move someone forward, is the ability to confidently present what you understand to be the case, but to base that confident assessment on real things. So if you're challenged, you have the ability to back up what you've said, and the ability in that sense to communicate not just the words that you've learned or the words that someone's written or the version that's been put into a document, but to communicate to other humans the story that those documents or the process communicates. In alternative investments, what we're trying to communicate in many cases is a fairly abstract concept. You might all say it's just investing in real estate, but some people are investing in real estate to develop something from nothing. Others are investing in finished products so that they can derive income from owning the building and charging rents. Somewhere in between are engaged in building things or rehabbing things and turning them into more valuable assets. You can't just refer to yourself as investing in real estate. You have to talk about what is it that you're doing? Where's your value going to be added? Where is the investor going to be rewarded? And finally, where is the investor at risk of not achieving the result that he or she or it has hoped to get by coming into the investment? Those who are talking about those things in a way that presents understandable versions of those longer concepts are really going to be able to succeed in gaining the confidence of investors in the programs that they represent.
Before jumping into our new product questions, I wanted to see how you viewed the changes in alternative investments from a regulatory standpoint as the allocation towards the industry begins to grow in investors' portfolios.
So what's interesting there is that there are kind of two completely different schools of thought on alternatives. One school of thought focuses on the complexities and the lack of predictability and lack of ties and correlation to the public markets, and says that therefore they're really only for the use of a very few. They're really potentially dangerous tools in the wrong hands, and therefore we need to both limit access to them and also limit the role they play in people's portfolios. And that's true whether they're talking about a retirement portfolio or just a outside the retirement account savings or investment plan. The other side looks at the ability of private assets in whatever form they're owned to add returns, to add diversification and non-correlation, to oftentimes increase the return and reduce the risk of a portfolio of assets by their inclusion, and says we should be doing everything we can to make those assets available to people, particularly those who are investing in smaller amounts because they're new to saving, or smaller amounts because they're older investors that haven't accumulated a lot of funds, and to sort of recognize that those kind of assets can make a huge positive difference to the saver or to the investor. And it's where those two schools of thought meet that we kind of have the politics of the situation. And we're back to the same point. Is it growth or is it protection? Which do we want? Which will we favor? Can we have growth without throwing out investor protection? Can we have investor protection without choking off growth? That's the balance we're always striving for. I think alternative investments, the story that we prefer is the one that says that their availability is a benefit to just about everyone, and that to hold them back for only the very few is not only not really consistent with their value, but actually represents kind of a value judgment that can often work to the detriment of the smaller saver.
Wonderful answer, thank you. Jumping into new products, what are some of the newest products or trends you see emerging in the alternative investment industry? And more specifically, what are some new products or trends that you see gaining prominence over the next few years, and why?
So it's probably right to first focus on, it's not so much a product as it is a component of products that have come into the marketplace and have enjoyed a lot of success. And what I'm talking about are products that offer some level of liquidity, meaning redemption, meaning exit for an investor, short of the time in which all investors are given an exit because there's a liquidation or a sale or a merger. A lot of alternatives were built for long-term hold. There was no liquidity. There was no midterm exit. The thought was you signed up for this path and you should stay on this path. And maybe if there's an extraordinary life change, a death or a disability event, there would be a liquidity option, but that it was very limited. And that a lot of people were perceived by the regulators as owning something that became a problem for them when they needed more liquidity than that investment would give them. So the industry responded by creating products that it had some level of liquidity. In other words, there was some regular pattern of offering to repurchase people's positions. Not just because they had a death or a disability, but because they no longer wanted to be in that investment. Or maybe they did have a death or a disability, but it wasn't conditioned upon that. So I think one of the major trends has been increased opportunities for investors to get liquidity for their investment in programs that hold underlying illiquid assets. And they do that by holding cash or liquid assets in addition to the underlying illiquid assets, so they have the wherewithal to meet the redemption request when they come in, when they've been solicited. The big tension that we've seen is sometimes there are enough people seeking to get out at the same time that there's not enough liquidity for everybody who wants to get out at once. Some folks say that means that the liquidity feature failed. We don't see it that way. We see it worked as it was intended. If it was intended to make 5% of the shares available for repurchase and 6% tender, and you buy 5%, and so everybody gets 5/6 of their requested redemption out, to me that's a functioning mechanism. Those who would say, well, not everybody got everything they wanted out and therefore it's broken, I don't agree with, but that is sort of the other way of looking at it in the marketplace, and that's why the product is still, for some people, something that they're watching very carefully. They want to understand whether this new desire to place liquidity as sort of a paramount factor in the investment decision is helping, or is it just window dressing and not really helping? And the audience is everything from the investors themselves to the regulators to the legislators who are trying to understand if this is something they should intervene on and do more to foster. So from a new product standpoint, that's a big part of it. You've seen that in real estate. It's also in other types of vehicles that offer periodic repurchases and interval funds among them. The other major product is to bring private debt vehicles to the marketplace so folks can enjoy the returns from private lending, which used to be done really by banks. So if you owned bank stock, you sort of participated in loan portfolios, but now you're actually investing in portfolios of privately placed debt. And those can be very lucrative. They also have different attributes than bank loans and other kind of more traditional lending devices. So we're seeing a lot of those in our space as well.
Just building on that response, with liquidity being, or illiquidity being such a staple of alternative investments, do you think the addition of liquidity options would change how alternative investments are viewed from a regulatory standpoint, or for those specific products that do offer that liquidity.
And that's where I think that it somewhat depends on which audience we're talking about. I think the investors and their advisors, whether they're broker-dealers or registered advisors, have seen the value of the extra liquidity and have felt that it gives them more options than before those features were part of the products. Regulators have focused in some cases on what I was describing before as sort of there was a rush for the exits and not everybody got out, or at least not everybody got out in full, as a way of saying, well, they didn't work. Our goal has been to try and talk to that audience and say, it actually worked as planned. Maybe the amount of liquidity desired was in excess of the amount available, but that's not something that broke. That's something where there was just more desire for liquidity than there was liquidity to meet that desire. What we've tried to say is if you want something that could meet 100% of people's desire for liquidity every day, well, we already have that. That's called a mutual fund. And that's subject to the rules on portfolio liquidity for that reason. So if you're not going to offer it a mutual fund, you've got to have some limit on liquidity, or you're going to have a fund that has assets it can't sell trying to meet redemption requests that are coming in that then don't get met. That's a break. That's a problem. If people are entitled to liquidity and can't get it, to me, that's a problem. If folks have an option for liquidity and they don't get it in full, I don't see that as a problem. I see that as a feature. As they say, not a bug, but a feature.
As a young person, I have to ask them about blockchain and cryptocurrency. So I want to know, how do you see blockchain technology changing the landscape of alternative investments? And are there any specific sectors within alts that are poised for a more significant transformation than others based on blockchain?
So what we've done in our events is to have spokespersons from the crypto space, the pure crypto space, where, of course, crypto is trading on the blockchain, or as blockchain is used to transfer ownership, and to hear from them separately from people who are just focused on the benefits of blockchain technology. Because blockchain technology can be seen as a different and perhaps better way of tracking ownership of assets that, if we go back 100 years, were kept in a journal, and we go back 50 years, were kept in a spreadsheet, and we go, now they're kept on an immutable log. So it's hard to say that that isn't an advancement, but at the same time, it doesn't change the nature of your ownership interest. It just means that your ownership interest might be harder to steal, harder to take away from you or defraud you of. But all of that's very different than crypto, which, despite its connection with the blockchain, because that's how it's accounted for, I'm still waiting to hear the investment thesis for crypto. And I think a lot of us are. We've brought folks from the crypto space in, and the ones who are having a great deal of success in driving returns from crypto, they draw the analogy. They're the ones not who are digging for gold like the 49ers in California. They're the ones selling the picks, the shovels, and the blue jeans to those who did mine for gold. Because the firms that came out of the gold rush that you heard about are those firms. They're Levi Strauss and the hardware companies that made the materials. We were going to have in our program a firm that was raising money to essentially lend to those who wanted to buy crypto mining equipment. Now, that's an investment thesis. We can talk about that all day long. But the thesis is people need equipment to mine. Mining is what they want to do. They need capital to do it, so therefore you're investing in that program. But that's not a bet on cryptocurrency, or at least on the direction of any particular currency, or whether a coin is a valuable asset, or whether it's essentially an electronic entry that could go to zero. So that's where kind of we are. I think we're willing to see blockchain as an interesting technology on the asset identification and transfer space, and we're willing to understand how the cryptocurrency world is a place for investment dollars. But I think I, for one, and many others in the association, are a little more comfortable with the idea of investing in the picks and shovels and the mining equipment side of the story than an outright investment in a cryptocurrency, hoping that the cryptocurrency will become more valuable for the investment thesis that the crypto converts use.
Building on top of the blockchain, can you briefly explain the concept of tokenization for those who aren't as familiar with it, and discuss its potential impact on accessibility and liquidity in alternative investment markets?
At bottom, an interest in an investment is essentially an accounting entry. You've transferred dollars into some entity, some account that is at the disposal of the pool that's going to use those dollars to invest in an asset or to trade them using a strategy or to buy a building. And your interest in that pool, your investment, has to be accounted for. It has to be accounted for both as to who owns it and what does it represent ownership in. So when folks are talking about tokenization, they're really focused on whether blockchain is a better way of ensuring that that interest is kept in as sort of safe and non-corrupt or corruptible manner as possible. So it might be that what was once upon a time a limited partner interest that was sitting in a vault or in a piece of paper or an electronic entry somewhere becomes a blockchain or a token entry. The problem is that it's a lot easier, because our systems were developed to deal with this, to transfer ownership interest when you can present it as a traditional paper or electronic entry as opposed to a tokenized entry, where you have to go through certain kind of procedures to validate and then transfer and wait for the acceptance of the transfer on the token side to occur. So I do think there's a future in which assets will be increasingly tokenized. But again, to me, that's really just a better way of tracking who owns what and doesn't change the nature of investing.
It's pretty early in the life cycle of blockchain and tokenization, I would assume, in alt. But can you share any successful examples of alternative investment products that have utilized the blockchain or tokenization, and what made them successful?
We do have real estate projects that have used tokenization of their interests, and the folks that have bought those for their clients feel confident that their ownership interests and the tokenization of the project will be to their clients' benefit. The alts space does include, as I said, a wide variety of non-correlating assets. One of the perceived values of crypto generally is the non-correlating nature of it. Of course, there are questions of what is it if it's not correlated? Why does it have value? Why would that value change? What would make that value change? But there are products that own what are called spot crypto. It's a way to trade in the daily valuation differences, ups and downs of the crypto markets as they are reflected in the price of Bitcoin and Ethereum and other major cryptocurrencies. So, I think that the fact is that industry has raised billions of dollars in new investor money, and it's been used to pile into the crypto market. That's probably a definition of success by most folks' standards. Money was raised for the purpose of buying an asset to yield returns for participants in the pool. That's success by that measure. I just don't know how long that's going to be perceived as an alternative asset. It is non-correlating, but at the same time, it's still tied to an investment thesis that's a little harder to put your hands around than the investment thesis underlying real estate, the investment thesis underlying private debt, even the investment thesis underlying gold and other specie is a little easier to wrap your head around than the investment thesis for crypto.
This has been a wonderful time. Thanks for speaking with me. Thanks, everyone, for tuning in. We're so glad you joined us for this insightful conversation on new products. And if you enjoyed this episode, please subscribe to our channel. We'll be back soon with more expert insights and student perspectives on alternative investments.